Most people start an investment plan with the wrong question. What should I buy? A stock? A fund? Something trending online? Start with a better question. What must this money do, and when? In the next few minutes, we'll turn one real goal into a practical investment plan. And I'll give you a free calculator to run your own numbers. Meet Maya. She wants $40,000 for a home deposit in 7 years. She already has $5,000. That gives her 3 useful numbers: the target, the deadline, and the starting amount. Now convert the goal into a monthly action. If Maya assumes a 5% annual return, compounded monthly, she would need to contribute about $328 a month. But that return is not a promise. At 2%, the contribution rises to about $380. At 7%, it falls to about $295. A stronger plan does not simply choose the highest return. It asks, can I still reach the goal if returns disappoint? Next, match the investments to the deadline. Money needed soon usually has less time to recover from a market fall, so liquidity and stability matter more. A goal many years away may have more room for diversified growth assets and short-term price swings. 7 years sits in the middle. Maya needs growth, but she also cannot behave as if the deadline is 30 years away. As the purchase date approaches, she can gradually move more of the goal money toward lower volatility holdings. Then check 2 kinds of risk. Risk comfort is how calmly you watch an account fall. Risk capacity is whether your life can absorb that fall. Maya might feel brave during a market rally, but if a drop forces her to delay the home purchase, her capacity for risk is lower than her confidence suggests. The smaller of those 2 limits should shape the plan. Now, diversify. One exciting company or one fashionable sector is not a plan. Diversification spreads the goal across different investments, so one failure is less likely to derail everything. Broad funds can make this easier, but a narrow fund can still be concentrated, so check what it actually holds and what it costs. Finally, automate and review. Maya can schedule the monthly contribution just after payday, then check the plan once or twice a year. Is the target still $40,000? Has the deadline moved? Is she contributing enough? Has market movement pushed the portfolio far from its intended mix? Review the plan when the goal changes. Not every time a headline changes. That is the full system. Name the goal, price it, set the date, calculate the contribution, match risk to the deadline, diversify, automate, and review. The free Finance 101 Investment Goal Planner lets you test your own target, starting balance, deadline, and return scenarios. Use conservative assumptions, include fees and taxes where relevant, and remember, this is education, not personal financial advice. The goal is not to predict the market. It is to give your money a job.